Welcome to another weekly market insight. Today we're going to do a quarterly recap since it's the first Wednesday after the end of the quarter. I will not be joined by John Gatewood today. We thought it would be a little bit better on a monologue since this is mainly a recap versus a conversation. So let's just jump in it, and whenever we're looking here, let's hope my spotlight is working. We can see our report card. So we put this together at the beginning, or really the end of last year, and just to see what we predicted and what has actually come to fruition. And if we're looking at the virus, we said that it would remain with us, but the susceptible population would be dropping, so the severity of the outbreaks would decline, but there would possibly be a third wave in early spring to summer, but that it wouldn't be as severe, and more because of more medical interventions, and as typically what happens with viruses, not always, but the virus will trade being more contagious for less severe. Now, it doesn't always work that way. The Spanish flu of 1918 would be an example where it started out less severe and very contagious and became more contagious and more severe. But for the most part, viruses do mutate to be less severe because it allows them to replicate faster. And we're not seeing an increase in hospitals that's significant, which is really what we're concerned about on that coronavirus. And then if we move down to policies, certainly had central banks remaining accommodative and could possibly be the only game in town. And that we talked about populism continuing to grow as a political power. Now, if you're only looking at mainstream headline or national news, you may not be aware, but a lot of the red states are really going to what's known as a federation model, and that populism is growing. A lot of what I think they're calling Second Amendment sanctuary states, which is a term that's borrowed from what Democrats were doing, the blue states, on sanctuary states for immigration policy. So both sides have been using more of a federated model and more decentralization, which is something that we had indicated as a long-term political impact, both left and right. We do continue to see that move, at least under the surface. You're not seeing too many national headlines, but certainly if you look at the state headlines, you're seeing that. The domestic economy, that we would be an expansive economy so long as the government policy did not get in the way. Thankfully, that seems to be an accurate prediction. The declining dollar would reduce imports and increase exports. This one hasn't actually come to fruition. The declining dollar certainly has, but on reducing imports, we have not seen that. We've actually seen an expansion of imports and a reduction in exports. Well, why is that? Well, down here, hindsight's 2020. The service sector is the last to recover. There's still money in people's pockets that they would have been spending domestically that would have not increased the imports. So that money's going somewhere, and a lot of it's just tangible goods, many of which are imported into the country. Most of our economy is a service-based economy, meaning that's where the domestic spending is coming in. So that was not seen by us, even though we have some clues here written in our prediction on why that would be the case. As supply chains are coming back and the market is, or the economy is reopening, we do see a trend towards this, though the dollar has increased over the last couple of days. GDP at 4 to 4.5% growth. I think we said last quarter that if we had to redo this again, it would be somewhere around 5 or 6, and we're getting numbers that the GDP growth in the United States has been very robust, near 6%. International, that we continue to talk about China moving into that developed market. The yuan would gain on the dollar. That's not been the case over the last week, and slowing their export-driven economy. Once again, that has not happened from our previous discussion on the import-export relationship and the declining dollar. That stock valuations would be stretched, and that we would lead to more names in the index. We have Krispy Kreme IPOing, and we do expect in the second half to see more names go to the IPO market, meaning that we'll see more names in the index. And then bonds, munis would continue to perform well if a blue government. It is kind of a blue government, but the margins are so small that it's really been a difficult government for the Democrats to get their policy through, especially with the filibuster. And basically the tied vote, if you could get it there, would be the vice president. So there is not a lot of room that Democrats have to move. Even though it's a blue government, they're certainly not free to just move their agenda, which has probably been frustrating to President Biden, which we'll get in here in a little bit. So let's start looking at the market and what had happened. So if we look at Q2 2021, we can see that the growth side at 15.42 was actually, large cap growth was the best performing asset class for the second quarter, where value did 3.82. And then if we go down, we can see that there has been a little bit of a small cap bias on the value side, but it goes exactly the other way on the growth side. Probably a reduction in the interest rates that is causing this in the second quarter. If we look at the large cap asset class for year to date, we can see that there's very little difference between value and growth. And you may be asking, well, Aaron, why is it that the taxable accounts are trailing if growth and value have been the same in the large cap area? And you said that it's been the growth that's been dragging. Well, if we look below, we can see that the mid cap and small cap value is still significantly outperforming the mid cap growth and small cap growth. And if you remember when we went over the tax sensitive attribution, it really was the BNY Mellon small mid cap that made up almost half of our underperformance, and then there was an AB small cap growth. So this is the area that is hurting the taxable accounts whenever it comes to performance. But it's good to see growth coming back, and we've actually been moving towards large cap growth over the last couple of weeks. However, if we look back 1 year, 3 year, 5 year, why would we have such a growth overweight? Why have we liked it so much? Well, 1 year, pretty much everything's similar except that small cap value is really outperforming, but everything else is near the 40s. If we go 3 years, though, it's quite a different story. That small cap value significantly underperformed the large cap growth, and that's the case even if we go 5 years. You want to be in large cap growth. You want to be in technology companies that are large capitalized companies for the last 5 years. And though we've had that value rotation year to date, which was really just the first quarter, we think that is reasserting itself again. If we look at the different sectors, quarter to date, we can see that energy had a great second quarter at 14.75. I think that's the highest performance that we have. And then if you go back to first quarter, you can see that it had a strong first quarter. So it's up 50%. It really paid to be in energy both first and second quarter, despite any type of value rotation. Let's look at our finance. That's not quite double digits, but getting there, and we can see that was the second best performing asset class. So for year to date, finance and energy has been a good place to be. We were in finance, and we've had some exposure to energy, especially in commodity stocks, but sorry, there's a little commotion outside of my room. The basic materials and energy, financial services, as well as industrials and real estate have all been good performers year to date. And then if we look down through the quarter, we can see that it was really energy, communication services, real estate, as well as technology coming back. And that was different from the first quarter. So then what about the market? Is it overvalued? Well, this chart is saying, well, let's look at each of those sectors that we just reviewed on performance and see what is the Morningstar fair value assessment. Now, if you're a 5-star stock, that means you're significantly undervalued based on the stock price that Morningstar is given. Or if you're a 1-star, you're significantly overvalued. If you're a 3-star, that means you're fairly valued, and if you're 2, you're slightly overvalued, and then a 4 would be you're slightly undervalued versus your price. You can see the only areas that really have any blue are really energy. There's a couple of names in healthcare and consumer defense, but most of the market is yellow, meaning 3-star, to orange, meaning 2-star. So is it a fairly valued to slightly overvalued market? Absolutely. It is really hard to find any bargains at the moment, but it's also not significantly overvalued. There's not a lot of 1-star. So we would continue to say the market valuations are rich. There is a premium and they are stretched, but we certainly favor them over bonds, which we'll talk about a little bit later. So if we look at U.S. real GDP and Morningstar's projections, you can see that it's projected, and we've seen numbers for greater than 6% already being posted, but Morningstar is projecting a 6% growth. We go back to what we projected. We said 4.5. We can see that that's a projection for 2022, and the economy is projected to move back down to about 2% on real GDP growth by 2025. Now, these are all projections. We're happy to see those numbers in positive territory. Now, what didn't happen over the quarter? What didn't happen is we didn't see any new taxes or additional stimulus bills, except that there was a $2 trillion, but we had about $6 trillion in the hopper ready to go with some significant tax changes, and that just has not been the case. We have not seen significant changes in tax law. We also have not seen the significant amount of increase in spending, which many may remember whether it's a President Trump or a President Biden, we don't think the government should be spending at the rate that they're spending. So we're happy to see that. We're also happy to see that there hasn't been any significant changes in tax law. Now, we still have the infrastructure bill that is likely to go through, but with the very divided government, though slightly Democrat, very divided, it's really difficult to get things through with a filibuster being possible. So we haven't seen many changes here, and don't anticipate significant increases in government spending beyond what is already outlined. Which is good, because we've been very concerned about the inflation risk, and we can see that it has moved up. Morningstar says it peaked. I think it's a little too early to say that it peaks. It's only something you will know in the rear of you. You've got to look back in history to see when was the peak. There's certainly a lot of labor costs that need to be priced into the market, as a lot of people have rethought the way that they have their work-life balance and made a lot of changes, a lot of work from home, or not going back to work whatsoever. And there's also the unemployment, which ends in September. We'll see at the end of September how much of an impact that has. But we can see Morningstar is projecting the PCE to be about 2.9%. And moving down to the 2%. That's still above the target rate of the Federal Reserve. And then we can see core PCE, which is not as volatile. But if we look at that inflation rate versus the 10-year Treasury bond at a little over 1%, it moved down to 1.3% and some change yesterday. So very, very low rates, certainly below what is currently on the being measured on the CPI or even the PCE for inflation measurements. So once again, our take is that inflation risk is high because you're not getting compensated enough to exceed what the inflation rate is, especially with fixed income. So at 1.3 or 1.5, wherever we are going to be on the 10-year Treasury, that's certainly not as high as 3% almost on the PCE or 5% on the CPI. And we've seen that the PCE, which was usually the most muted measure for inflation, is certainly 2.1% versus 1.5%. You're losing to inflation, and this is before any type of advisory or investment management fees or taxation if you have them in an account. And it doesn't matter if it's, and like I said, a Roth would be the one exception where you wouldn't pay tax on that, but you would eventually pay tax on your IRAs as you distributed it, and then also if you had it in a taxable account. So certainly below the inflation. You are definitely losing purchasing power if you're in these types of instruments. And you could make the argument, well, you just don't need to buy treasuries, go buy other debt. Well, when we look at the spread of the U.S. corporate bond index, which is really just strong quality bonds, and then we look at the high yield, the spread is very narrow, and I'm not going to call really a high yield bond high yield at 300 basis points or 3%. Certainly a lot of risk there for credit quality that I don't think you're getting compensated. Now we do have some high yield. It always makes sense in a portfolio context, but the only way that you would get above the inflation and the expectations was to be 100% of your fixed income in high yield, and that would be just significantly beyond the risk level. They often move like equities if we have a downturn, and that's the only place that we think bonds make sense in portfolios right now, is providing a ballast. So we can see that you're just not getting compensated. This is the reason that we talk about inflation risk being high. Now let's look at the different asset classes. If we look at the S&P 500 for the second quarter, it was up a little over 8.5%, where the mid cap is at 3.6 and the small cap's at 4.5. So once again, the second quarter didn't see a lot of movement by going down to the market cap in the portfolio. That's not the case for year to date, which still includes the second quarter. So that first quarter, really significant outperformance if you overweighted small cap and mid cap versus the S&P 500. And then we can look down to the next level, international. It's up 8.83. The only area that is under that as an equity would be emerging markets at 7.45. And you can shift to the second quarter and you can see most of their year-to-date performance was actually achieved in the second quarter. A little bit better than small and mid-cap, but certainly not doing as well as the S&P 500. And then our surprise to us, because fundamentally we're not really bullish on real estate, especially corporate real estate and retail space. There's a lot of headwinds there. That has not detracted from performance. So though we're underweight in our view, fundamentally we are overweight whenever we look at technicals, and that brings us to a neutral weight in portfolios, especially on the qualified side, where the tax implications of holding real estate is deferred just like every other asset. So we do have a neutral weighting there, but we are surprised to see 22.94, and we wouldn't want to overweight this because of our fundamental story. We'll continue to have a neutral weight so long as the technicals indicate. Now, commodities is not something that surprises us at 21.15% for the year. 13.3% for the quarter. It's really the energy sector. Precious metals have not been doing well if we get underneath the hood. So it's really that energy sector, followed by some typical basic materials. And this is prior to an infrastructure bill being passed that we've seen this. And this has a lot to do with our concerns for inflation. Now, so let's look at some technical charts. So the Russell 2000, or really that small cap, is where you wanted to be up to the second quarter, and we're hesitant to be there. It has lost a lot of momentum. So these three X's is known as a triple top, and it was declining. This is known as a point and figure chart. It's a really easy way to kind of see what's happening on price movement. A lot easier than, let's say, charting, where you're just looking at the graph. And then we've been in an O column, which means that it's been declining. This was done yesterday. It actually broke through this bearish triple bottom. So Russell 2000 is not a place to be based on technical analysis, and we have lightened our load with several trades over the last couple of weeks and moved to that large growth. So if we look at the S&P 500, this is looking a lot better than the small cap as of late. It's gone to new highs. When I printed this off yesterday, we were moving into a negative column. Not so for the NASDAQ. So you want to be in large cap and you want to be large cap growth, and we can see that here with the NASDAQ hitting new highs. And then if we look at the Dow, kind of that value side of large cap, it doesn't look as rough as, let's say, the Russell 2000, because it does have some large cap exposure, but it's not signaling a very bullish chart when we're looking at that. So just kind of a recap, going into the third quarter, we've certainly moved back to large cap growth. We think it's going to reassert itself. Taxable accounts really never left there because we thought that it was only going to be a couple of quarters where the value rotation happened. We didn't want to pay tax on the significant gains that we had from the previous year. In addition, many of them didn't go long-term until March, which really, looking back, maybe the end of the value rotation, just to have to go back to growth. So we're happy to see that growth side reassert itself, because that means all of our accounts can participate. We do still see inflation risk is high, not as high with $6 trillion of spending really being in question versus what we were predicting at the beginning of the year. But once again, talking about where you're getting compensated on bonds versus where the inflation rate, which is higher, we think that inflation risk is real. That's why we favor equities over fixed income and continue to do so. We continue to favor the U.S. domestic market over other areas. We continue to favor technology, especially large cap growth. We are bearish on international. We've left this bearish on real estate on a fundamental basis, but we're actually neutral weight whenever we're looking at qualified accounts because technically real estate has been working. So price points, we talked about this dome a couple of weeks and that we went through price objective of 45.60 on the S&P 500. This is not a call. If somebody asked us, hey, what's your take on the S&P 500 for the end of the year? This is just saying when we look at how long we stayed in that trading range and then the movement up, we predict that we would see some resistance again at 45.60 as we came up to that price objective would change. This is actually an older chart, so I apologize that this is an older chart. The S&P 500, if we were looking at the new one, has moved up to about the fourth or fifth position, and only technology, so large cap value or large cap growth, NASDAQ 100, NASDAQ equal weight are above the S&P 500, and I believe real estate as well. So I think the S&P's at the fifth. What does that mean? That means you want to move to the large cap U.S. domestic market, which is often kind of a risk-off trade, especially where interest rates are, and everything else is basically underperforming. So if you have a diversified account, it's very difficult to beat the S&P 500 right now. Now we have a significant overweight, and we expect to continue to do so over the long term. Sorry that this is a dated slide. And then if we look at our performance for our strategy, this is as of Friday, tactical mutual fund almost 18%, while the benchmark's at 14 for the year. That's up about 400 basis points over its benchmark. If we look at the quarter, we had a solid quarter, but we were about 9 basis points behind the benchmark. Not the same for tax sensitive. There we're struggling year to date with 7.38 behind a benchmark of 14, so we're down 6.62. But we do have some positive movement relative to our benchmark. So our tax sensitive was up 7.38, while the benchmark was up 6.75. And we can see that kind of goes through those that were heavy growth. Now all of our portfolios are heavy growth. We have about a 60 to 75% weighting of growth versus value across our benchmark. So we expect, if this growth rotation continues, which we expect it to do so, that we'll start to see some nice positive differences here relative to our benchmark. And we certainly have a decent amount to catch up. We do think we are in the positions that can do that, though, year to date. So I believe that ends our presentation today. I hope you enjoyed the quarterly recap. If you have questions, feel free to call our number at 314-924-5100, or you can go to our website and up in the quarter request a demo, and that will get you into contact with a lead advisor here at Gatewood Wealth Solutions. And if you have not done so already, please click that subscribe button so that you never miss an update. Typically, John and I are doing the weekly market insight And then also we will do a daily 3x3 on Monday, Tuesday, and Thursday, where we do a recap of the 3 relevant market movers that day in 3 minutes or less. And if you enjoyed this recap, make sure to hit that like button. And while you're at it, if you think any of your friends would join it, hit those arrows and share it over and send them a link to our YouTube channel. So I will turn it over to Jess. Thanks, guys.